talk about budgeting and planning for cash. What is that all about? So let's delve into it. First of all, we all know that cash is money, you know. And like the saying goes, cash is king. Cash is always king. So people would usually want to hold cash. They'll usually want to hold cash and want to preserve cash. There are several reasons for holding cash. And some of the reasons are one, if you remember, for those of you who did business in school, we call it the transactionary motive, the precautionary motive, and the speculative motive. These are reasons for holding cash, or motives for holding cash. So that's what I mean by to settle transactions. I mean, that's a transactional motive or transactionary motive of holding cash. Cash is needed to pay expenses. You use cash to pay for your SWOT class. You use cash to pay for your school fees. You need cash to save transport to go where. So that's transactionary. But there's also another side of holding cash, which is called precautionary. Precautionary. And precautionary is basically you're taking precaution against unexpected things that happen, So you are putting money aside, to take care of something bad that might happen in the future. And that's why people go for insurance, actually, And there's another reason, which is called the speculative reason. You hold cash in order to take advantage of business opportunities and investment opportunities. That's speculative. Anytime you hear the word speculative and finance balance, it simply means investments, opportunities, business opportunities. So you hold cash to take advantage. If you don't have cash, you can't take advantage of certain opportunities. So these are the three reasons for holding cash. A lot of people hold cash because of transactionary, Few people think about the precautionary, That's why few people might have, there are few people who have a fund to take care of, unforeseen events. There are few people who have even funds for investing. Most people dabble around the transactionary motive. So how does this apply to cases? Basically, you you look at cases in terms of why the organization will need cash and the effect it will have on them if they don't have the cash. The effects on them if they don't have it. Can you please mute your microphone? Yeah. Okay, so that is the reasons for holding cash. But what are the objectives of good cash management? What is the whole purpose of good cash management? The whole purpose of good cash management is to hold sufficient cash, which is an asset, to take care of liabilities when they fall due. So that's the whole purpose of cash management. Cash is an asset, as you'd all know. But you want to manage it in such a way that it's able to meet liabilities in a timely manner. So that's what I mean by as they fall due. So you don't also want a situation where you are holding too much cash and there's really no use for holding that amount of cash. Because cash sitting idle in your pocket does not necessarily benefit you, except for the transactionary motive. That's why I took my time to explain the three reasons for holding cash. And if you're a student of finance, you realize the time value of money. You know, time value of money is basically saying that you would want money now than in 5 years. Because in 5 years, the value of the money would have gone down. So just letting cash be sitting idle in your pocket is not a good idea. So you do not want to hold too much of cash that is not necessary. You would want to release some of this cash into investment opportunities or even precautionary ventures. So those are the objectives, you know, when you're thinking about cash, those are the objectives of cash management. Very, very key. So what are the aspects of cash management? What are the aspects of cash management? I'm taking my time to go through this because cash is one of the areas where which is a place of concern for a lot of organizations. So what are the aspects of cash management? The first aspect of cash management or managing cash is in terms of how you forecast your cash flow. It's in terms of cash forecasting or cash flow forecasting. You know, and I left a note there that in your exam, it is more likely that you'll be required to prepare a cash flow forecast rather than a detailed cash budget. So a cash flow forecast is simply a futuristic statement showing how much cash an organization will need over a period. So you should be able to forecast your cash flow, just like you would do for yourself as an individual. If you look into your life, you can tell that, oh, based on how I see things over the next 5 years, I'll need this amount of cash because you'll probably be married, you'll probably have kids, you'll probably have a car, have a house, or a place you are renting. So you can tell how much cash you need based on, you know, those factors. Another aspect of cash management is how you will invest surplus cash. How would you invest surplus cash? So, like I was talking initially and saying that cash itself, you don't let it lie idle. You don't let it lie idle. You don't let it lie idle. So what you need to do is that you need to ensure that surplus cash is invested. You know, it's invested. So you need to have a fine balance between how much cash you keep and how much cash you invest. This is very, very important. How much cash do you keep? How much cash do you invest? And that's what I mean by deciding how much surplus cash you need to invest. Because sometimes if you overkeep cash, you'll be losing in terms of the investments you could make. If you underkeep cash too, you know, your transactions might suffer. So you need a fine balance between the two. Let's talk a little bit about cash budget. A cash budget. So what is a cash budget? A cash budget is basically, it helps you to, you know, budget for cash receipts and payments over the planning period. A cash budget is typically what you do personally. It seems close to what you do personally. So you have a budget. Okay, you say, oh, this is the amount of money I have. So I'm budgeting. This is the amount of money I want to spend. And this is the amount of money I want to save after. That is the whole principle of a cash budget. A cash budget. It helps you to manage your cash, manage your pool of resources, and actually monitor cash flows during the planning period. So the cash budget becomes a standard against which you measure your actual cash receipts and expenditure. So that's the whole essence of a cash budget. Once you set the cash budget, you're able to compare it to what actually happens. Then you see what went wrong and what went right. And that's how you prepare a cash budget. So it will have a receipt section, it will have a payment section, and to have a surplus or a deficit as the difference between the two. So yeah, so that's it on cash budget. And the benefit of a cash budget is, like I said, it helps you to monitor cash flows. It helps you to monitor cash flows. So like the case we looked at last week, right? One of the things they had to do was budgeting because their cost was going way too high. Way too high. You don't know exactly where their costs were going. So they will certainly need budgets. And understanding these concepts, you'll be able to apply them and say, you know what, where is the money going to? Where is the money going to? And that's the monitoring aspect. That's the monitoring aspect. The second benefit about a cash budget is it gives you an understanding of what receipts and payments will be over a period. It gives you an idea. Okay, so you're able to tell, okay, this will be the cash receipt, this will be the cash payment. Okay. For a human being, you can say, oh, my salary will come in, maybe this side hustle is there, that side hustle is there. So, you know, those will be my receipts and this is what I'll pay for, you know. So that's so that's how like it works. That's how it works. There are several other benefits in terms of the cash budget will tell you there's a shortage of cash at a certain point and how to handle the problem or handle that shortage. So those are some of the benefits of a cash budget. So this is how it looks like. This is how it looks like. You see how a cash budget looks like? So it will talk about, like I said, your receipts, your payments, and you know, whether you have a surplus or a deficit. Very, very simple. Very, very simple. So your receipts, it will be clear, okay, where will these receipts be coming from? So for an individual, let's say Andrew, cash receipts, Andrew will say, okay, salary, 20,000 Ghana in January, February, 20,000 Ghana, March, 20,000 Ghana. What other receipts? Maybe side business, 40,000 Ghana. Okay. Then comes to payments, whatever payments he has to make. You know, that's the whole idea of a cash budget. And this is the way it looks like. So you list the organization's cash receipts, and you list the organization's cash payments, and net it off to see if there are any surplus or deficits. Any questions so far? Okay, let's move on. Can you mute your phone, myself phone? There's somebody making noise with their. Okay, it's better now. Okay, so when you move on to what we call the cash flow forecast. the cash budget is basically showing how to manage your cash. So it tells you what is actually happening now. Like, it tells you, okay, these are your cash receipts, these are your cash payment. But the cash flow forecasts are more of a predictor. The cash budget too can help you to manage your cash. But the cash flow forecasts are more like a predictor. They predict future cash requirements. Future cash requirements. But the difference is that unlike the cash budget, your cash flow forecasts are prepared throughout the financial year. And another thing is that they are prepared in much less detail than the cash budget. Than the cash budget. So that's something to take note of. The objective of the cash flow forecast is to be able to predict what the cash flow requirements would be. That's one. Another thing is that it helps you to assess whether operating activities, that is the day-to-day activities of a business, are generating the cash that is expected. So you would want to understand, okay, my day-to-day activities, how is it giving me money? How is it giving me money? It also helps to let you know which times or which periods where there will be a shortfall in cash so that you can arrange for financing. These are objectives of cash flow forecasting, and they help to keep the organizations on its toes in terms of how they plan their cash. So that's it. That's it for cash flow forecasts. So this is how a cash flow forecast looks like, and I'm sure in maybe one of your papers, maybe somewhere in the ICA, I don't know if it's reporting or something, you should have known how to prepare a cash flow forecast. I think I didn't skip slides. Okay. So you have your expected trading profits, which you can call PBIT, profit before interest and taxes. Then you add any non-cash items. Depreciation is a non-cash item, so you add it. And basically, your cash flow forecast can be divided into operating, investing, and financing activities. You talk about adjustments in working capital. So if there's an increase in inventory, what does it mean? An increase in inventory takes cash out of your pocket. So it will be minus 15,000, like you see in the example. Increase in trade receivables. These are people who owe you. So it means that money is out of your pocket or money is out of your organization until they pay. So that's why you see minus there. Increase in trade payables. These are people you owe, right? And so the money is still with you. So that's why you see positive. So that is the idea around cash flow statements or cash flow forecast. For example, something like an investing activity where you buy an asset. If you sell an asset, that's a positive cash inflow. If you purchase an asset, it is a negative cash. It's a cash outflow, I should have said. So that's how the cash flow is presented. I'm sure I wouldn't want to bore the, accounting students, because I'm sure all of these things, they have a grasp on it. But basically, that's the understanding around the cash flow statement. This is a typical example of one. And to know how to prepare, the cash flow statement is not true and poor. It's not true and poor, I beg. So you just need to know the impact of the items or the transactions on your cash, on your cash. So for example, you went for a loan, you are repaying the loan. What would happen to your cash? You would have to use your cash to pay. So that's the cash outflow. There's nothing to chew about this. Okay. You are paying off, let's say, a dividend. Yeah, so money will go out. So yeah, that's basically the idea.
Your national identification database. Technology captures a series of photos of a person's face at various lights.
Hey, what's that? Can you please mute? I beg you. Why is mute on? Anyway. Then we move on to, there's also another format. There are different ways of preparing cash flow forecasts. There's a cash flow statement approach, which I showed you here, which a lot of you will be familiar with. And there's the revenue and cost estimation approach. As we all know, EBITDA or EBITDA, depending on where you're coming from, which is earning before interest, taxes, depreciation, amortization, is usually approximated to cash. I'm using the words very carefully. I'm not saying it's cash. I'm saying it's approximated. It gives you a sense of cash. And so that's where this kind of format or approach comes in. And I'm sure this one might be easy for a lot of you guys. So when you look at your EBITDA, you can say, oh, it gives me a sense of my cash, basically. It is not cash, but it gives you a sense of your cash. Please take note of that. So EBITDA can be approximated to cash. So this is basically your P&L as you have it. You can see here. I wouldn't bore you with a lot of things. So you have your sales revenue forecast, you have your cost of sales, you have your gross profits, expenses. Then you have your net profit. Then you add back again your non-cash items, which is depreciation and amortization, and to get your EBITDA, to get EBITDA. And that gives you a sense of your cash. Any questions so far? Any questions so far? Can I move on? Okay. So we talk about ethics and financial management. Ethics and financial management. What is ethics and financial management? So let's talk about stakeholder interest first. Then we'll see how it ties into ethics. We see how it all ties into it. You all know that stakeholders have expectations. They have things they're looking forward to. Everyone has their own interest. Everyone has their own interest. If you put 5 people in a room to argue about something, people will argue based on their personal interests. So every stakeholder, a stakeholder is simply someone who has an interest in the strategy of an organization. So every stakeholder has their own interests. And there are different kinds of stakeholders. I've listed some examples. There are tons of them. I'm sure in your readings, you would have realized that there are tons of them. So you have employees, employees, what would be their interest? They want job security. They want salary. Customers, right? What will be their interest? What will be the interest of customers? They want value for their money. They want value for their money. Suppliers, what will be their interest? They want credit-worthy customers. Communities, they will expect that jobs will be provided. The general public and the government they are more interested in, safety or concern for the environment. So these are expectations of different people or different people groups and how they see the whole stakeholder metrics. But in this arrangement, there are sometimes possible areas of conflict. And one of the key ones is shareholders and managers. Shareholders are the owners of the company, and managers are those who run the affairs of the company. They run the affairs of the company. So if you realize that shareholders, they are into increasing their wealth over the long term. So they are long-term focused. They are long-term, so they are looking more for sustainability of. But managers, they come and go. Managers are employees. They come and go. So they are more interested in meeting short-term performance targets. So you see, one person is thinking long-term, another person is thinking short-term. And this is where the conflict of interest begins. This is where the clash begins. If you don't remember any conflict of interest, please remember the one between shareholders and managers. Shareholders and managers. And per chance, if your case raises a situation where, the company was run by managers, right? And I got to a point where maybe somebody, a group of people came to buy them, or they floated shares on the market, and a couple of people bought majority, and so they became the majority shareholders. One of the things your mind should be going to is this conflict of interest. In the case we looked at last week, I think the owners were the managers. So you might not necessarily have that situation. So that's a possible conflict of interest. So I was coming to the description of this type of interest. It's called the agency conflict. Agency conflict. The word agency is coming from agent. It's coming from agent. So it's just like shareholders have hired managers to undertake a task. So these managers are agents and shareholders are the principal. There exists between them what we call a fiduciary relationship. A fiduciary relationship. So it's a principal-agent relationship. Very, very key. Very, very key. A fiduciary relationship. So what do I mean fiduciary? It's a big English word, but fiduciary means it's a relationship that involves trust. Involves acting in the interest of another. That's the whole point of a fiduciary relationship. Because you are an agent, you must act in the interest of another. You don't seek your own interest. Otherwise, it's not fiduciary. So agency conflicts arise because of the differences in the interest between owners and managers. And we see this in certain areas, which is earnings retention. Sorry. which is earnings retention. And another, so let me explain earnings retention a little bit. Let me explain earnings retention a little bit. So, you know, the whole goal of management is to make bonuses or to make money, you know. And so when you tie their bonuses to earnings, you know, what they do is they try to manipulate the system. They try to manipulate the system. How do they do this? They'll try to find ways of meeting the target, even though it's not necessarily sustainable. They are just looking in the short term and looking at how to make their money. And so this is one area where conflicts arise, you know, conflicts arise. Another area is with respect to the time, you know, like I said initially, shareholders are concerned about the long-term financial prospects. Managers are concerned about the short term, you know, because their bonuses are based on short-term performance. It's not based on long-term performance. So why worry about the long term? You know, another thing is in the area of risk. In the area of risk, you would realize that money, you know, the higher the risk, the higher the return, right? You know, but it's not all risk that is worth taking on. But because managers are more interested in return, and money, they might take on certain risks that might not necessarily be in the best interest of shareholders, you know. So can you please mute your oh dear. Why can't I mute everybody? Anyway, yeah, so they might take actions that might not necessarily be in the best interests, you know, of the company as a whole. So you have these conflicts and the areas of these conflicts, and it's simply basically a clash between owners and managers. This is very, very important. Very, very important. And that's what we call agency conflicts. If you don't remember any conflicts, like I said, please remember this one. Do not forget. Okay.